One of the key points that we made in our last class was that when we think in terms of the intersection of finance, technology, innovation, markets, and multiple stakeholders, it's a fairly complex web, right? And I think in terms of complexity, the point that we'd made last time in our last class was, so if you think in terms of finance and technology, you're at the intersection of finance, technology, infrastructure, consumer behavior, data, models, and network. And somewhere in between is, this term called fintech, which I'd said last time and I'll say it again. I really, really dislike. I don't think it does justice. I think it sort of creates a very simplified, crude variation of reality. And reality is actually quite complex. So whether you look at the banking industry, whether you look at brokerage, whether you look at insurance, whether you look at scoring, whether you look at credit, whether you look at other applications of finance and technology, you'll find that there are multiple challenges. So with this course, this is not a rah-rah course in the sense that we're not going to go out and say that fintech is the be-all and end-all of all the problems that we face in the industry, specifically in the financial service industry. We're going to go out and say that there are certainly opportunities that we would benefit from, and our objective is to look at those opportunities with a very cynical perspective. So we're not going to take anything at face value. We're not going to take anything at as is. We're actually going to dig for hard data, and we'll try and look through local context. So how does this actually work within the local environment and the local context, right? And in that context, I think our basic idea is whenever we see an opportunity, we want to look at that opportunity from the perspective of evaluating its impact, its future potential, and its effectiveness in the real world. So I think in our first class we looked at payments. आज की class में we are going to look at trading models. And I think those of you who saw the assignment जो हमने पहले share किया था, in that assignment we sort of asked you to look through the background coverage of a book called Flash Boys, which was written by Michael Lewis, and that focuses on essentially a debate between a new exchange called IEX and high frequency trading. So in today's class, our objective is to sort of dig a little deeper into this so that we have a more informed exposure, more informed understanding of the issues that were discussed in that specific discussion, and then take it from there. I think when we just like we say fintech is a very simplified, very shortened, very crude description of a very complex image, when we say trading models, I think the same holds true. So if you think in terms of opportunities within the trading model space, where are those opportunities, right? एक सबसे बड़ा area, one of the biggest area that a lot of you would be interested in, that I am interested in, where I had some background, is what we call algorithmic trading. Right? So this is like a big header, and essentially what algorithmic trading does is that it identifies or tries to create filters that suggest action. And you have two choices. One choice is that you automate the model, which basically means that the model ingests data, processes it, and uses it to look for specific signals. And then once it finds, it being the model, finds those signals, then it goes out and takes action. And that action could be buying or selling securities, right? That's one part. So algorithmic trading, from our perspective, high level, basically looks for trading signals. And the idea is good algorithms, great algorithms, have a track record of generating decent returns from the perspective of their stakeholders, right? That's one part. A second part, again in the same space, is what we call order management and execution, right? So if you have a large block order, if you have, a big thick chunk of shares that you want to buy or sell, but you don't want the market to sort of catch awareness of what's happening, you want to execute them, you're looking for best price, you're looking for fastest execution, you may have multiple factors and filters, good order management and execution system, and the word that we use for it is OMS. So I have a good friend, Yusuf Jan. He's one of the co-founders of a business called Mixit. I don't know if you've heard of it. Yusuf and his team then sold Mixit, I think somewhere in 2008, 9 or 10. And there was a big deal, it was a big transaction for the local technology industry. And Yusuf now runs with a team of colleagues a similar business, or a more, sort of a recent variation of the same OMS platform under the name of Traffics. So that's sort of like a third opportunity. Then, so all of this, best price execution, trading and data filters, all of this falls within the OMS space. Then there is risk. So how do you sort of measure risk? And risk, I think you'll find that there are two big challenges. Most of the risk systems, most of the risk parameters, filters, traction, records that we look at are what we call post-trade, which basically means that once the trade has occurred, then you get some indication of what kind of exposure you've created. If you have something which works on the pre-trade basis, which is difficult to sort of implement and execute, then you have an edge and an advantage. And there are some OMSs and there are some systems and filters that do a very good job of managing that. Then after this, you got paperless settlement and confirmation. And when I'm sort of describing this, I'm describing this within the context of broader financial markets. So there's some markets where this is already done and taken care of, and there's some markets where this is not done and not taken care of. So depending on which part of the world you find yourself in, you may find that some of these opportunities are still open, while others are, have been sort of taken care of and have been closed for many, many years. Then after this, you've got trading networks. So you in the IX Flash Boys case study, you saw references to dark pools, and you saw references to private exchanges, right? So that's what I mean by creating formal or informal trading networks for giving or creating value for either your stakeholders or your customers. Then there's another big part. So, related to the field of risk management is what we call counterparty risk assessment. And this has multiple areas and multiple ramifications depending on which market you work in. And then finally, you've got regulation and you've got compliance, right? So if I were to sort of bundle this together, I'd say algorithmic trading. So this is 1. Order management and execution. So this is 2. Risk is 3. Settlement, confirmation and execution is 4. Trading networks is 5. Risk assessment, counterparty risk assessment is possibly 6. And then compliance and disclosure is 7, right? There are 7 key areas in which you've got potential opportunities when it comes to trading models and algorithms. Now the next question that comes up is yes, these are the areas where opportunities are, but if you were building a team, if you were working with a business that was trying to explore or work or expand on these opportunities, where would those opportunities be? So the biggest one and the easiest one is inefficiencies, right? Again, with both the Flash Boys and the IX case, you saw that it was an interesting paradox that the inefficiency created was not due to speed. Sorry, the resolution to the inefficiency created was not by speed, but was actually slowing down. So one interesting question, one interesting perspective, and that's the reason why I picked up the HFT IX case, is speed, faster, cheaper, better, is not necessarily always the best possible solution. So one element is that. A second element is, figuring out how to short circuit or sidestep the gatekeepers. And when we talk about doing this, we're talking about doing this remaining within the legal frameworks for your market. So there's a possibility there. Then there are models that are very paper thick in the sense that they generate sheets and sheets of paper. So if you could simplify that, if you could reduce the amount of paper output, that helps. Then there is interconnection, execution, best price, and value, right? That's one part. Trading algorithms have one very important strong element, and that is what we call back testing. So I may have an algorithm, I might create it, I might think this is something which is very, very valuable, but unless and until I back test it, unless and until I get it to a point where the world can see that the algo has worked in the past, the algorithm is not very, very valuable. And finally, with trading signals, I think the challenge here is that the signal is not constant. The signal evolves it moves, it shifts. So you have to keep an eye on, whether the signal that your model was built on, is that signal still relevant and effective, or it's not. So in the context of our discussion today, we want to talk about some of these areas. There are certain themes. Some themes we'll touch when we discuss the IEX Flash Boys case study. Some themes we will discuss with respect to the material that I have to present today. Right? Our context is essentially financial markets. And within financial markets, there are 4 specific areas that are of interest. One is fixed income, one is FX, which is foreign currencies, one is equities, one is commodities. On the market side, on the stakeholder side, we've got customers, obviously, but we're also interested in what's happening on the custody, clearing, and settlement side and the regulatory front. And then on the execution side, there are 3 terms that we use: front office, middle office, and back office. And we'll very quickly breeze through them. So what I want to do is I want to set the context first for the discussion that's going to happen next. And then I want to go out and give you a specific instance of what does it take to actually create or build or craft or discover or design a trading algorithm. We want to set some context with respect to this whole trading space, themes, terms, terminology, and some of the key issues that you need to be comfortable with. One, we want to talk a bit about innovation, right? So how does innovation actually work? So if you don't have millions of dollars or billions of dollars at your disposal, where do you start? What do you want to do? This also sort of ties in with one of the requirements for this course is going to be a paper that you're going to write as an individual on your own on an area within the themes that we've identified on day 1 that you pick. And within that area, you identify an opportunity and you explore that opportunity. You sort of build the business case for that opportunity. So when building that opportunity, one big question is going to come to your mind is, okay, what do I have? There are others in the market with lots of money and capital and experience and expertise at their disposal. So what do I have? What do I bring to the table, right? And that sort of leads back to what you see in front of you, which is, how do you define what drives innovation when you don't have access to lots and lots of dollars? So for innovation to work, I think there are a handful of simple questions or simple drivers or simple factors that you should be aware of. I think the first question is curiosity. So whenever you're trying to sort of look into or investigate or you decide to expand or innovate a given market, I think the first step is, why does this work? Or why does this doesn't work? Or why should we accept things as they are? Or how do I make it better? So that's the first part. I think the second part is what we call empathy, right? And so I may be curious about how markets work or how markets behave, but I must have some kind of a connection for me to sort of say, okay, I'm going to investigate this and find out how this actually works, right? So that's the second part. Third part is the willingness to experiment. So you sort of create or formulate a thesis, you test it, you fail, and then you repeat the entire process again. So in Brad Katsuyama's case, the central character in Flash Boys, we see this again and again, that his first element was, what's happening to the market? Why are my orders not getting executed? And then his empathy part came essentially because this was his job. This was the part that he did and that he worked on. And his thought was, something is off, something is not right, and I need to figure out why things are working the way they do, right? And then in terms of experimentation, both at RBC and then at IEX, the primary mindset was, how do we solve this problem, not just for a small percentage of traded orders, but for a larger chunk. So that's the first 3 personal requirements, right? So if you're thinking in terms of innovating, the 3 things you need to be aware of are curiosity, empathy, and a willingness to experiment. Then you have to understand, or you have to accept, that innovation cycles run over a fairly long period of time. And for you to be successful within these cycles, you need to give yourself not just time, but also the option, also the capacity and the capability to fail multiple times. So that's the second element, right? So this is one, this is personal, this is in terms of mindset. And third is you have to reach for goals which are within your grasp. So, if you're sitting and thinking of doing something interesting or useful in the local market, you also have to evaluate, do you have influence? Do you have access? Will people listen to what you're saying or suggesting? Do you have the capacity to bring people together, right? Which then brings us to number 4. So this was 3, which is collaboration, right? So these are the 4 primary themes that we see again and again when it comes to innovations that have taken hold in our market, which is Pakistan, in regional markets, which is the broader MENA region, as well as in other developing or developed or frontier economies in our immediate neighborhood, right? So this is one part. I think the second part is, remember I said poor man's innovation, right? So the assumption is that you're not Goldman. You don't have billions or trillions of dollars available either on your balance sheet or in terms of credit lines. You're just a small team working in a small market. So if you're a small team working in a small market, there needs to be a clear link between income generation and innovation. And the reason I'm spending time here is, when you come up with ideas, when you think in terms of opportunities that you want to explore, that you want to identify, that you want to work on, it'll be useful for you to keep this, to bear this in mind. Okay. So link between income generation and innovation and local context. And these 2 requirements would be key for the papers that you submit with respect to opportunities in the financial technology, innovation and disruption space. Now, if I were to summarize innovation as a framework, not just within financial markets, but also outside of financial markets, there are 3 primary key requirements. And you will see these again and again and again. So there's a lot of research that supports this. The first word here is immersive. So you must have some background and expertise or exposure in that specific field. And we'll see instances of this later today. The second is iterative. So you have to do it again and again. And the third is a willingness to experiment and fail. Okay. So this context, what we've just done, is with respect to innovation. Remember, we said finance, technology, innovation, and disruption, right? So for innovation, if you want to innovate, if you want to change things, if you want to come up with interesting different frameworks, you want to change markets, you need to be willing to understand and work with these 3 specific terms: immersive, iterative, experimentation. So again, finance, with respect to finance, there's just a handful of key foundational theories, right? So we work in and around them. But if you think in terms of algorithms, generally algorithms look for a handful of things. So when you talk about trading signals earlier, and I'll actually give you an example a little later, you look for signals that indicate mispricing. So there is some measure of evaluating whether something is overpriced or underpriced. So if it's overpriced, you'd sell it. If it's underpriced, you'd buy it, right? That's one. You look for what we call arbitrage, where you could possibly buy some combination of inputs that would basically go out and create the output. And you sort of, depending on what is cheaper and what is more expensive, you'd buy the cheaper stuff and you'd sell the more expensive part. So that's 2. You look for signals. So there are signals that are linked to release of market data, signals that are related to correlations between different factors. You look for leading and lagging indicators. So you'd see there's a huge universe of trading algorithms. And the interesting part about them is that they're not static. They change because markets learn from how people trade and behavior changes. And as behavior changes, the signals and the models also change. Did that answer your question? So gatekeepers could be large stakeholders. Gatekeepers could be large players. Gatekeepers could be regulators. Gatekeepers could be market participants who have an enormous amount of influence. Gatekeepers could also be customers. It's a very broad generic term. But these are generally people who you need to get on your side or on your team, or at least convince them to sort of give you a chance to make things work. अगर आपने नहीं पढ़ी है, so I'd strongly recommend, if you can find a copy of Flash Boys, either online or offline. I'm not sure कि Liberty Books में, I think I saw it some time ago, but I'm not sure कि अभी है या नहीं है. If you can get a copy of Flash Boys, I'd recommend कि आप Flash Boys पढ़ें. It's a brilliant book, very fast read, and it sort of highlights everything that we're going to cover today. It sort of brings that to bear in terms of context. And there is a lot of debate around that, and we'll discuss that when we look at it a little later in the second half of the class. But I think for now, I'd recommend कि अगर आपने नहीं पढ़ी इसको एक नज़र देख लें. I think you'd enjoy the book. It's a great book. It'll also give you more context about it. Okay, so now I'm going to very quickly breeze through local context. So when I say fixed income with respect to local markets within Pakistan and the region, I'm essentially looking at treasury bills and bonds and corporate debt if that exists. When I talk about foreign exchange and FX, I'm talking about the proprietary desk and what we call the flow business in the banking world. So this is on the treasury side, right? When I talk about equities, we're looking at straight equities, but we're also looking at leverage and margin lending and the roles played by brokers within the equity space. Look at commodities, we're looking at spots as well as deliverable, non-deliverable futures and forwards and derivatives and options. Now, have you done, before this course, have you done either treasury or portfolio models? Have you sort of covered this as in terms of basics? ये कर चुके हैं आप? या this is the first time you're seeing it? You're taking a course in treasury funds. ठीक है. Now, so we'll just very briefly focus on some of the key ideas from what we call the trader mindset, right? So what do traders do? ये लोग करते क्या हैं? And these themes are important because when you talk about algorithms, they have implications on what kind of algorithms you design and use and work with. So if you think in terms of what do traders really do, the first thing that traders do is, and that's sort of the most important element, is in any given market, the first question a trader needs to ask himself is, what is this that I'm working with worth right now? So if you think in terms of let's say the USD PKR exchange rate, right? It is shuttling somewhere between 159 and 161. So what's driving that? A, and that is it likely to stay on the 161, 162 side, or is it likely to go down to the 157, 158 side, right? This is a question a trader asks himself and answers it almost on a daily basis. So what is something worth? And will the price hold at current levels and volumes or not? That's one part. A second part that traders do is what we call market making, right? So they're willing to both buy and sell. And, there is a term that you must have heard in the discussions around IEX by both Brad and Michael Lewis, which is about, providing liquidity. When we spoke about high frequency trading or HFT, one of the so-called benefits of the HFT world was provide liquidity to the market, right? Whether that's true or not is a different debate, but that's the concept. So market making basically ensures that if there are buyers, there are sellers willing to take the other side, and if there are sellers, there are buyers willing to take the other side of a trade, right? That's market making. Third is spread management, and spread management essentially is there are multiple areas here, multiple implications here. It has a different connotation in the banking world, different connotation in the trading world. High level, I think simplified, crude description is essentially, I want to make sure that the dollars that I bring in are greater than the dollars that go out, right? So the amount that I earn in terms of exposure or volume or balance sheet or rates is greater than the amount that I spend or expense. Okay, so that's 3. So फिर इसके बाद I think the next big step, the next big area, next big component that we want to be comfortable with, specifically when looking at algorithms, is what is your investment style. So investment style, there are 4 styles that are of interest to us. One is what we call growth. So basically we're talking about fundamental analysis, and the analysis is focused on your current business model, and the idea is, the high level thesis essentially is that the market is underestimating growth potential of the security in question, right? And by investing in it at this specific point in time, your expectation, your hope is that, when the market sort of corrects its anticipation or expectations about the performance of this specific security, the specific script, prices will go up. So that's one. Value is a different style. Value is the market's overreacted. So in most instances to bad news, or because of some other external factors, a specific instrument or security or position is not trading very well relative to what it should be. And at this specific point in time, your interest is buying it at a discount to book, discount to cash, or discount to sales. Third is momentum. So you're basically playing with the direction of market dynamics and the psyche of partners and players. And the fourth is technical analysis, which basically says, price changes provide signals or patterns and trends, and there is intelligent analysis that is there in these four areas, right? So depending on which style you come from, growth, value, momentum, or technical, that will define what your trading algorithm, what your trading mindset, what your trading style would be like. Okay. So the three terms that we'll use again and again. One is front office. So front office is where the deal, the trade, the transaction happens. Middle office is where we check, okay, whether the limits are in place, we're not sort of violating or breaching any risk restrictions, any other both legal, compliance, regulatory, or responsible financial action, right? So that's where the middle office piece comes in. And back office is where the settlement and the execution of a trade happens. This is also done. So if you think in terms of flow, at a high level, if you're a trader, you do ticket entry, which is basically your order, and that's done by what we call a front office dealer. And that at this specific point in time, a limit checks happen. And then the ticket or deal or trade or transaction is approved by your front office manager. Then it goes to back office for verification. So this limit check and here, this part is where you have a automated middle office in place, or should have in place. In some instances, some markets, this is manual. In other instances, other markets, a number of checks are actually automated because you have a large flow of orders, and it's only exceptions that require attention by your middle office team. So back office verifies the ticket by making sure that you've the right counterparties, you've got the right trade, you're not sort of doing anything which is not sort of within the mandate of your team, your limits are in order, and then it goes out and authorizes, and then it essentially ends up and heads towards your accounts or your backend GL or general ledger. Okay. What we've just done is a very high level, very quick, very speedy, very breezy review of the context. Right? This is the world we are going to step into when we think in terms of algorithmic trading or trading models or trading tools. So from an innovation point of view, we had three elements: immersive, iterative, experimentation. What we're trying to do is take a shortcut here so that we can appreciate the discussion that happens, right? So we're trying to make sure that everybody's on the same page with respect to the world we're going to step into. And in that world, fixed income, FX, equities, commodities, price discovery, market making, spread management, styles of growth, value, momentum, and technical, and trading and treasury functions of front, middle, and back office, and workflow review. So हमने immersion को touch कर लिया in terms of giving you some context and background. Now I think what we want to do is we want to emphasize two more points. One is experimentation, and to my mind that basically means being open to change. So you want to go out and try things out. इसमें नुकसान क्या है? इसमें the big challenge is what we call failure, right? So how do you sort of compensate for failure? You compensate for failure by providing A, capital, and B, a framework that allows you to fail smart and fail fast. Okay, so एक element here. Second element is iterative, which basically means that we have something to test or prove or experiment or play with. So we're going to go through it till we get to a stage where we found a solution or we've run out of capital. Okay, there are only two instances, right? It's binary. Either it'll work or it won't work. If it works, that's fine and well. We'll grow, we'll prosper, we'll do well. If it doesn't work and we sort of ultimately run out of attempts to repeat, then we'll run out of capital and we'll shut down and move on with something else. So with these three areas: immersive, experimentation, iterative. So immersive, iterative, experimentation. We want to now move in the world of trading algorithms. So now what I'm going to do is I'm actually going to start off with the simplest of algorithms and the simplest of use cases and instances, and then I'm going to walk through the development of very simplified algorithm that we worked on some years ago. And the idea, the expectation on my part is that by giving you a sense of how that algorithm was put together, you get a look behind the scenes of what it takes to build, to develop, to explore, to backtest or deploy an algorithm. Okay. So now, first question. You have something in front of you, right? What does that represent? Yeah, so these are pairs, right? So Euro USD, USD JPY, JPB USD, GPB USD, USD CHF, USD CAD, AUD USD, right? These are all currency pairs. And then this is what? This is your forecast. So the spot rate, and हम बात करें 2019, 2020 की, so this is a little dated. The spot rate is, so for example, Euro USD, the spot rate is 1.14. The expectation Q2 2020 was 1.06. Did that happen? Did not happen? We don't know. We'll have to actually go back and look. Q, because we don't actively trade Euro USD, right? What about AUD USD, right? So that's the Australian dollar versus the USD. The rate is 0.7 spot. The expectation is it'll move to 0.67. Did that happen? We don't know, right? So up now, if I ask you to develop a trading algorithm that would allow you to forecast FX prices, where would you start? So if I ask you to build a trading algorithm that will trade FX, foreign exchange, pairs like these, exchange rates on a regular automated basis, where would you start? What question would you start off with? Is there a thesis that you'd look at? Something that you explore? So for example, right, you can see the spot rate at the point that I took the snapshot was 1.14. And this is as of, I'm guessing this is August 2019. So this is July, August 2019, right? July, August 2019, the spot rate for Euro USD was 1.14. So on what basis is this forecast coming that by end of Q2 2020, this would be 1.06? Okay, historical trends. और इसके अलावा, is there a model? आप लोगों ने इकोनॉमिक्स पढ़ी है ना, मैक्रो पढ़ी है ना?
Uncorrelated interest rate parity.
There we go. Who was this?
SN.
शाबाश SN. SN आप यही काम करते हैं? So the word that SN used was interest rate parity, right? Which basically says that there is a relationship of sorts between interest rates between different economies, and if that relationship is violated, then there is opportunity for an arbitrage. And there are certain themes or things that sort of boundaries or restrictions that work around interest rate parity, but within a broad domain of things, this is how the market prices it. Okay, so we have a model, and that model is interest rate parity. Okay, there is another model, right? And that model is what you see in front of you. You've heard of the Big Mac Index? So the Economist publishes this. अगर आप Economist लाके देखें, so it'll have this on the last few pages of every Economist print edition as well as Economist Online. And what you see here is comparison between the Big Mac Index from July 2009 to July 2014. That's one shot. This is July 2016, and this is July. So this is January 2018. Is that the same model as interest rate parity, or is it different? नहीं, but from a modeling point of view, जैसे SN ने बात की थी कि हम यहाँ पे interest rate इस्तेमाल कर रहे थे, यहाँ पे हम क्या इस्तेमाल करें? हाँ, but term क्या है उसके लिए? So the term that we use is PPP, which is, who knows the answer? What does PPP stand?
Purchasing power.
Yeah,
Purchasing power.
and this is also SN.
Yes.
शाबाश. सिर्फ आपने ही CFA किया, किसी और ने भी पढ़ा है क्लास के अंदर CFA? Purchasing power parity क्या कहती है? इस केस में ये कहती है कि if you want to actually look at FX trends, you want to figure out whether a currency is overvalued, undervalued, so आप एक काम ये करें कि आप Big Mac की कीमत ले लें in that market, right? So for example, पाकिस्तान में Big Mac, I don't know कितने का पड़ता है. Who's had a Big Mac recently? What's the cost of a Big Mac in Pakistan? 300 रुपए, 400 रुपए, 500 रुपए, 600 रुपए, stop me.
400.
So let's say 400 रुपए का Big Mac है. Let's make it easy. Let's make it 480 रुपए, right? तो 480 रुपए डॉलर टर्म्स में कितने बने? तो अगर पाकिस्तान में बिग मैक आपको $3 का मिल रहा है और अमेरिका में वही बिग मैक चलता है $5.28 का, तो वेयर इज द करेंसी? Is Pakistani currency overvalued or undervalued with respect to dollar? Remember, what is the question? The question is, अगर 480 रुपए का, if a Big Mac costs 480 rupees in Karachi or Lahore or Islamabad for that matter, in dollar terms that's roughly equivalent to $3. So the cost of a Big Mac in Pakistan is $3. If that cost is compared with the cost of a Big Mac in the US, that cost is $5.28. So is the Pakistani currency overpriced or underpriced with respect to the US dollar? With respect to FX, you've got this model which is driven by interest rate parity, and then you've got this model which is driven by purchasing power parity, right? They're both models, they both focus on the FX side. They both have limitations, they both have challenges. Whether they work or not work in the real world is a interesting debate. So there are restrictions and limitations on both. If you just said, okay, I'm going to build an algorithm which is going to be driven by interest rate parity, you are likely to lose your shirt. If you say, I'm going to build a model with respect to purchasing power parity, you're also likely to lose your shirt, right? The only thing that's going to save you is what we call immersion. And immersion is what? Immersion is background, experience, exposure. So I'll give you a couple of instances and examples of what I mean by immersion, right? And in a lot of not just CFA literature, but in your coursework at IBA as well as part of your bachelor's and your master's programs, what you'll see is ultimately हम बात क्या करें? We're basically saying what is the objective of a trading algorithm? High level के ऊपर is risk and return trade-off. High level के ऊपर it's a decent comparative return on capital, right? So return on capital with some predefined thresholds for preservation of capital, right? So we want to make sure that we preserve capital, that we conserve capital, that we don't lose capital, right? Is that a fair assessment? At a high level, the objective of a trading algorithm is to provide return on capital and balance risk and return trade-off. If you speak from philosophy point of view, that's what we want the trading algorithm. We might do it manually, we might do it automatically, we might do it through a system, we might do it through code, right? But that's the ultimate idea, right? Return on capital while balancing risk and return. So if you're balancing risk and return, what is our definition of risk? And the most common definition of risk that you're likely to play or come across or use or see in most measures when it comes to trading is volatility. So the uninteresting word is standard deviation. The terminology that we use is volatility. So जो आपके सामने चीज़ नज़र आ रही है ना, this is basically a daily plot of what we call a percentage change in price on a single day. So for example, अगर आप यहाँ पे देखें, there's a peak here which is about 10%. There's another big chunk here. So on the high side, you'd say the maximum return is maybe about 11% in a given day, and on the downside, it is what is that? This would be maybe about 7%. So top side, given single daily return, and when I say single daily return, this is essentially अगर आपके पास this is your new price, this is your old price, this is a plot, a crude plot of P1 minus P0 over P0. So अगर आपकी कीमत, if your new price is 110 rupees, your old price is 100 rupees, and your base was 100 rupees, that would give you a 10% return, right? Which would be 10%, which would be 10 divided by 100. Does that make sense?
Yes, sir. The holding period return.
No, your holding period is a single daily return. This is for one single day. So the plot is for a single day. So this is a daily percentage change. Holding period return would be over a period of time. In this specific case, our holding period is a single day.
हाँ सही है ठीक है.
ठीक है. अच्छा जी. So अगर आप इसको निकालें for oil, right? So oil यहाँ पे we have multiple choices. We've used WTI, which is one of the index. An alternate index is Brent, and then there are other blends and flavors or benchmarks. So WTI is one blend that deals with West Texas Intermediate, which is a flavor of the crude. Brent basically deals with another flavor, and then you've got local flavors or regional flavors. Jisme you've got the Saudi Arabian light, Saudi Arabian heavy, you've got Murban, you've got Zakum, you've got Iranian heavy, you have Dubai for Oman. So there are pricing benchmarks, there are blends, there are flavors for oil. We're looking at WTI, right? So compared to the previous class, this asset class, when you look at oil, do you think or would you say oil is less volatile or more volatile? क्या रिएक्शन होगा आपका? If this is all you had to look at, right? If this graph and chart that I gave you, that I put in front of you, this is one asset and this is a second asset, right? So what would be your reaction? Which one's less volatile? Or more volatile for that matter? This is, let's call this A, so security A, and let's call this B, which we know is WTI.
So B is touching plus minus 15%, but A is not. So more orange one or B should be more volatile.
So the range for the price movement, the daily price change for B is certainly higher than A, right? But till we actually crunch number, we won't know. From a high level superficial pass, it appears that you're right. It seems as if B or oil is certainly more volatile, right? So from a market point of view, right, when most people see, when you look at numbers, is this what you see?
And strictly saying we are taking standard deviation as a measure of risk. कोई और measure लेंगे तो ये different भी हो सकता है.
लेकिन अगर आप from a markets point of view देखें, so what do most people in markets look at? They don't look at volatility. They look at prices, right? This is the same data.
Yeah, VAR. They would probably go for VAR.
Yeah. No, but I'm saying in terms of when most people look at a trade or a position, we are programmed to look at it not from the point of view of risk or volatility. We are programmed to look at it from the point of view of price. So यहाँ पे कीमत is $120, यहाँ पे कीमत is where is this? About $30. यहाँ पे कीमत is again back to about $70, $75, and here it is about maybe $50, correct? So we look at price, and the point that I'm trying to make is that when you think in terms of raw data, you actually have a lot of data in and around price. What you really want to do is identify signals within that price. And the first step in identifying signals within that price is to start here. So this 2.47% daily, excuse me, this 2.47% daily volatility is basically a summary of this entire data set. So what have we just done? This was, for lack of a better word, noise. What did you reduce that into? Signal. Does that make sense?
Yes, sir. Yeah.
ठीक है. अच्छा, आप यहाँ पे पहुँचे कैसे? You don't see this when you look at financial market. You don't see this. What do you see? you see price data, which means that somebody has to convert this chart into the chart that you saw above, right? This one. Someone has to take this data, which is essentially price dimension, into risk dimension, which is here. So that's the first step, right? That's one point of view. But is volatility constant, or does it change? Is price constant? Would you prefer this that you see here, or would you prefer this? Which has more information from your perspective? अब क्या किया आपने? What have you done now?
So average out कर दिया ना per year.
So what do you prefer? Do you prefer this or that?
Daily price.
So you prefer to look at this, correct?
Yes.
But if you want to get a good sense of where prices are with respect to history, would you get an answer faster by looking at A, which is this presentation, or B, which is this presentation?
So A.
So if I said in August 2020, no, sorry, where are we? We are in February, right? So in February 2021, Goldman says oil prices will hit $75 a barrel by the time we get to Q3 or Q4 of 2021. Based on this data, what will make it possible for you to decide whether that's a credible statement, a likely statement, a possible statement? Would this be faster for you to say, okay, हाँ, Goldman is making sense, or would this be faster? Quick vote on this. Let's just do a quick vote again in chat. Just put in your answer. So A or B, right? The question is, if you're evaluating the future market, evaluating the future outlook of markets, would it be possible for you to make that evaluation by looking at this, which is A, which is basically a daily price trend, or would it be possible for you to make that determination by looking at this, which is your annual average price by year? तो ये 60 था, ये 80 था, ये 80 था, 11 was 80, 12 was above 80, sorry, over 80, 13 was over 80, close to 100, 14 was over 80, close to 100, and then 15 was 50s, low 40s, 50s, and then 18 we picked up, and then 19 was a terrible year, 20 was a terrible year, right? And we're now saying that it's going to hit and come back and go all the way back again to 75. So again, these are just representation, right? It's a function of what we are used to seeing. If you're used to seeing yearly averages, you'd prefer yearly averages. For example, I would prefer this, but if you're a trader, active trader, you'd prefer this. But if you're a algorithm and you're looking at risk and return both, right? So this is price and this is price, but within this, I don't have a blend of information. I don't have volatility. So if I'm looking for signals that sit at the intersection of risk and return, this will not work, nor will this work. Sitting at the intersection of risk and return, I'd like to see something along these lines, right? And what is this? This is so the blue part is your price data, and this orange trend line that you see is volatility. But it's not daily volatility, it's the moving average. It's the average 28-day, 25-day volatility on a looking back basis. So you can see here, so ये जो है, this ties to this index. So you're seeing that in 2008, in August 2008, daily volatility had hit 8%. And then similarly in 2010, daily volatility had hit close to 1%. फिर it jumped again in 16 यहाँ पे to 6%, then it fell again to 1%. तो अगर आप ये ग्राफ देखें, if you see this, right, are there any trends that stand out? Are there any relationships that you can see based on this data? Something that you say, this looks interesting. If you are a trader, if you're trying to build a signal, if you're trying to sort of create an algorithm that sort of compares and contrasts volatility as a measure of risk and price or price changes, कुछ नजर आ रहा है आपको? Could you build a model from this? And if you did, what would that model say? Could you build a model around oil prices? Could you build a trading engine or a trading algorithm around oil prices with what you see here in front of you, which is a plot of...
Inverse relation.
There we go. Very good. So, यहाँ पे volatility is high, and what has happened to prices? They have declined. And यहाँ पे volatility...
Minus 0.7 correlation.
Minus 0.7 correlation. So we've just added a new term to this discussion, right? And that is correlation. And this correlation is between what? Correlation between volatility and price. Did everybody follow what just happened? हमने कहा कि जब ये ऊपर जाता है, when this goes up, कीमतें नीचे आ जाती हैं. This goes up, कीमतें नीचे आ जाती हैं. This goes up, कीमतें... Can you see this trend? जब भी ये ऊपर जाता है, whenever volatility, trading volatility, tracking volatility हम calculate करें, whenever that goes up, we see a decline in prices. Even here also, it went up, prices came down. And when it goes down, when it's at historical lows, prices are at historical highs. So when vol is low, prices are high. When vol is high, trailing vol is high, prices are... And that has held true for August 8 to December 18 data set. Do we know if it's true now? We don't, because we haven't done the plot. So आपने thesis क्या बनाई? आपने thesis बनाई कि आप vol को track करें, and as your volatility estimate sort of starts to move up, then you should start to reduce your exposure to crude oil, right? That's the thesis. How do you validate it? You actually have to see whether it will hold in the future. जी हसन बोलिए.
Some 10 minutes break मुझे चाहिए. अगर आप ले रहे हैं तो ठीक है, नहीं तो मैं 10 minutes में आ जाऊँ.
नमाज की ब्रेक?
जी.
I think आप ले लें. I think अभी क्या बज रहे हैं? It's 6. अजान हो गई?
नहीं होने वाली है.
अच्छा, तो फिर I think let's just take a quick 15-minute break. अभी बज रहे हैं 1:15. So let's meet at 6:30.
Okay.
ठीक है. Let's just meet at 6:30 and then we'll continue at 6:30.